Good to see and appreciate your time, and hope we're keeping safe for you. Or how do you read markets right now?
Oh, well, look, they're very uncertain, and as Will pointed out with those numbers, look, I think every data release, people are parsing them with some care to try to figure out what the ultimate direction is here. And you will have seen, I'm sure, many commentators of the view that we may see a technical recession on the next GDP print in the US, meaning just really two consecutive negative quarters, but not yet any clear sign that employment is deteriorating, which would, of course, be the big risk for a deeper recession. So I think it's a very, very uncertain time. And with us having the second inversion in the yield curve, I do think, we'd have to accept that a recession of some form seems like a given now.
In terms of what this is going to, how this is going to impact the market, yes, we can see a recession, but there's also the case to be made that some equities are going to be, I suppose, in a better position even with a recession. So if you're thinking just in the context of deployment of capital for investors next 3 months with all of these uncertainties, where should they be putting their cash?
Yeah, look, I think it's a combination, Will, obviously, of looking for pricing power because we do have high inflation levels. So obviously those who are part of the positive side of inflation on their revenue lines should benefit. Clearly associated with that, margins, and just seeing what's happened to them, I think across the board margins are a bit weaker now. And then I guess the third element, which is probably the most critical, is whatever happens over the next 3 to 6 months in terms of the trajectory of the economy. I think we have to accept that the world has changed in fundamental ways in terms of this particular dynamic being driven by excess demand over supply shortage. So I think we should be navigating towards areas of the market where there is clear signs of some kind of structural shortage. So if you put those three things together, on the pricing power side, we like pharma. Health is an essential. The pharma stocks have held up pretty well. Obviously, we like energy, notwithstanding the recent retreat. We still have oil hovering around $100 a barrel. The big oil companies have been making very good profits at these levels, not to mention the refiners. And then on the food grains and fertilizer side, we did see a big rally in those immediately after the war started in Ukraine. But I think they're now pretty cheap. So we'll be looking to step back in and maybe top up our existing holdings.